Joining me now, Ross Gerber, CEO of Gerber Kawasaki. Ross, great to have you here. Thanks so much for joining us.
Yeah, thanks for having me.
So Ross, we had that impressive reversal yesterday. Stocks staged another rebound today. I'm looking at green arrows across the board here. Is the market right to breathe this sigh of relief? What do you think?
Well, I think obviously whatever Trump says, the market's sort of reacting to, and obviously the continued selling in the markets was something that brought Trump's attention. So he wanted to reset expectations about the conflict to try to boost the stock market, but it doesn't change the reality of oil prices and how it's going to affect the economy and how it's going to affect the inflation numbers and then interest rates and all the effects of these decisions. So that does put pressure on stocks, and there's no way around it.
So stepping back, do you look at this as just a short-term scare for investors, the geopolitical risk, obviously, the spiked oil prices, or does it actually change the bull case for stocks this year?
Well, I think it does change the case for stocks. I don't know if it changes it out of a bull case because we still have really good fundamentals to the backdrop to the market. I think it's more about the valuation multiple that the market has was a premium kind of price to perfection, and now we're clearly not in perfection. So the market has to reprice to a much more reasonable multiple, which actually can bring stocks down without earnings going down. So if the war ends in a reasonable amount of time, which is, let's say, less than 3 months, obviously the long-term effects of this are wildly positive. So investors have to look at the other side of the coin, not just the short-term economic implications, but how about the long-term economic implications of a free Middle East without Iran as a menace is wildly bullish. So, I just don't see a reason to sell stocks because of this war. If we're ever going to bomb anybody, Iran is probably the right people to be bombing.
Okay, but as we think about buying the dip and potential bottom being in, how do you think about that with the current market, especially given the fact that we've experienced so much volatility and so many down days? But if you take a look, the S&P is basically flat now year to date, only down about 0.2%. Do you think that, given the fact that even oil is sharply off its highs, but is still up significantly year to date, which can have implications, does that mean it could all get worse for the market before it gets better?
Well, and I wouldn't say that we found a bottom in the market by any means. For us, we look at around 6,000 at the S&P would be a great price for us to buy. That's the price if there is a correction that we think the market will get to. Certainly, we'd be buyers if stocks go down, 5, 10, 15%. Nor would we think that that's, abnormal to have a correction in times like this. So markets have actually performed pretty well considering the uncertainty that's been created through this war. But I think a lot of that is predicated on the idea that what this looks like after the war, as I said, could be one of the paradigm shifts in what we called in the old days the axis of evil, that taking out one of the leg of the stools really weakens the other evil players, which are Russia, North Korea, and now China has been added to this axis. So I think there's a lot of positive that can come out of this if they manage it right. The problem is the people managing the war aren't the smartest people in the world, and very rarely do wars go your way. So, time is of the essence. The longer this goes on, the worse it is for America. And Iran knows that the longer this goes on, the better it is for them. So that's why they're pushing so hard to hit Iran hard and get results quickly.
Okay. You mentioned around the 6,000 level on the S&P 500 that you would be a buyer. What are you doing now? You just wait on the sidelines? Are you putting any money to work right now?
Truthfully, we've been taking money out of the market more than putting in the sense of our allocations have been shifting more conservative and more diversified. So no, we're not being more aggressive. We're still always buyers of stocks because we have new money and such. And so relative to our allocation, we're buyers. But, I'm cautioning investors, this is a time to be defensive, to obviously have part of your portfolio invested for the future, and that's always a part of it. And whether that's 50% of your money or 75% of your money or 90% of your money depends on your risk tolerance. But if you're somebody that was running your accounts at, let's say, 75% in stocks, it's not a bad idea to look at lowering that allocation right now because of all the risks out there, and having cash available for if there is this correction. You know, what we always tell investors is if you don't have cash and then the market corrects, then it just hurts you. But if you do, then you can take advantage of any decline in the market. So, you know, I think that's where you want to be positioned. You want to have the ability. That's what I've done with my ETF GK, is we've built a little bit of a cash cushion in here. So if there is a decline, now we're still buyers of stocks, but relative to our overall allocation, it's lower.
Okay, so I have some of your highest conviction ideas that you sent over. I want to run through those, and then I want to know if these are names that you are waiting to buy or that you would buy now. The first one is Netflix, which did have a dip to buy until recently. It's actually done quite well more recently, although it's still off, almost 30% from the highs. So tell us why you like Netflix.
Well, Netflix has been a core holding for a very long time, and when they started down this merger pathway, we were very disappointed with their desire to be involved with Warner Brothers because it's not a great asset, and it's never made anybody money despite 5 separate owners. So nor does Netflix really want to release movies in the theater. So, you know, we saw this as a departure from their business model and problematic. So we sold some of our stock in the higher prices, and then it declined too much. And then we added it back around the $75 range. But as the T-winds shifted, we became very confident that Netflix would walk away from this deal, make billions of dollars, and avoid a disaster, and then position themselves to be the dominant player in Hollywood as Paramount Skydance swallows up, you know, so much debt that they're not going to be able to be competitive in the future. So in a way, it almost like took out competitors from Netflix instead of adding a competitor, because Netflix got them to overpay by 2 times what Warner Brothers was even worth. So this was just a masterful play from Netflix, and we expect them to continue to dominate, and we expect the stock to fully recover back to around the 125 range as they move forward this year. So we still see Netflix as a great opportunity, and we're buyers of the stock.
Okay, next up, Eli Lilly, one that's down about 6% year to date. Tell us why you like this one.
Well, like is a nice word. I love this stock. You know, they are changing the world for a much better place through their GLP-1 drugs, and we're just about a month away from getting approval for their pill. And the GLP-1 pills, which started with Novo a couple months ago, have been wildly popular, and the Lilly pill is even better than the Novo pill. And it's a once-a-day pill you can take at any point in the day, and it cuts your diet and you lose weight. I mean, this is like it's like a dream for people, I think, for generations, to be able to take a pill and lose weight. And with obesity being a massive problem in America and globally, this is a wonderful step in the right direction. But even better, they have this new drug, which is called GLP-3, which is coming out next year, which is way better than the current versions of weight loss drugs, and really, really effective. So everybody in Hollywood's already taking this illegally already, and that's why you don't see a lot of overweight people in the TV shows anymore. But essentially, this combination, along with their other drugs, puts them in the pole position, and their main competitor, Novo Nordisk, is extremely poorly run. So they're not only a better company, they're better management and better drugs. So we expect Lilly to dominate this market for years to come.
Okay, the inside scoop from LA with GLP-3s.
Yeah.
All right, here's one that the market certainly loves this year. Micron shares are up more than 40% in 2026. You like that one. You also like Nvidia. Would you be a buyer of both here?
Yeah, in fact, this is probably one of the things that I think is so crazy about the stock market right now, is how mispriced Nvidia and Micron are, even Micron more than Nvidia. I mean, there's like this continuous doubt about the future of AI, despite everybody diving in and using AI at every major company in the world right now. You know, it's so funny how in one breath, everybody's like, oh my God, AI is changing the financial industry. Oh my God, what's going to happen? And then the other breath, they're like, well, you know, maybe these chip estimates are too aggressive, you know? And I'm like, we are at the beginning of what this is going to be. And the valuations are just wrong with Micron because there's just no acceptance that their earnings are going to go from like $8 a share to like $30+ a share. And so like if you just do simple math at $30 a share and 15 times earnings, Micron is still undervalued. And 15 times earnings seems absurd for a chip company growing by hundreds of percent. So if you, God forbid, you do 20 times earnings, you're getting into some big numbers here. And then with Nvidia now trading at a forward multiple of under 20, where its long-term PE has been around 40 to 45 for over a decade, if Nvidia makes their numbers this year, the stock has tremendous upside. So, the doubt about these numbers creates an opportunity for investors. If you believe in AI, Nvidia and Micron are the two players that benefit the most from infrastructure build out. And it just seems like the market just has mispriced these stocks currently because of doubts about something that everybody's all in on. So it's a huge opportunity, I think.
This isn't on your list, but I have to ask you about it because I think every conversation we've ever had has involved Tesla. You've been both bearish, you've been cautious. Tesla is about 20% off the highs right now. Would you be a buyer here, or are you still in the
I'm still
not
a seller
so positive
of Tesla
camp?
here, and I think Tesla's got big problems in front of it. Elon's 100% focused on SpaceX right now and trying to get that money for XAI and go public. Tesla, is struggling in all areas of their business now other than battery storage, which is really the standout in their business is storage, which is growing. I mean, really great business that they have. But they've given up on the EV business. They basically don't care about selling cars anymore. And consumers don't like Elon as it is, but their lack of focus, advertising, or any real attempt to sell cars ultimately will hurt them greatly because that's their cash flow business, and by just sacrificing this on the hope of the robo-taxi, because we know the robot's far off into the future and we're not sure whether there's a use case for that robot yet. We've seen these videos of robots folding clothes and stuff, but it's definitely not as effective as a human. And what it turns out is humans are really effective at many things, and that's why we've existed for, millions of years. So it just turns out that maybe this robotics thing may or may not work out to the economic benefit that they hope, but we won't know for many years into the future. So they've bet the company to be basically an autonomous Uber. And if you look at what the value of Uber is and you times it by 4, it still doesn't make any number that Tesla has on a valuation basis make any sense. So I just show me how the numbers make sense. Now, it doesn't matter what the stock is in my mind. From a financial perspective, the stock is worth like $200 at best. So, I just think it's a tough stock to own. And I get, because I have clients who want to own it, I get they believe in Elon and this vision of the future. And I'm not saying to them not to believe in that. I just don't believe in the economics of that future. And it has to be proven to me, and it hasn't yet.
Okay. All right. We're just about out of time. But before we let you go, we want to play a rapid fire game of this or that with you, Ross. Are you ready?
Yeah.
All right. Here we go. Stocks, bottom in or more pain ahead?
More pain ahead.
Buy the dip or stay defensive?
Is the dip now? If this is the dip, I'm staying defensive.
But when we see S&P 6,000, in your view, that's when you're buying.
I push in my chips, yeah.
U.S. markets or international markets?
International markets.
Surging oil, short-term scare or market killer?
Short-term scare.
Inflation, transitory spike or a structural problem?
Ooh. I'm going to have to say we're starting to get more to our problem. It's the Trump policies are all inflationary.
Okay. Recession in 2026, yes or no?
No.
Rate cut in March, yes or no?
No.
Your one must-own stock for 2026?
Well, I just gave you 3 or 4, but if I had to own just one, God, it's hard to bet against Nvidia and Jensen.
Okay. Your one must-avoid stock for 2026?
Ooh. Must avoid is a big term. I would say And I'll put this out there, Berkshire Hathaway, avoid.
Oh. Because of Buffett being gone?
The Buffett era is over, and Abel, what he's trying to do is kind of hard. This is sort of a creation of a different century, and the modern century isn't going to be kind to all these businesses. So they got to break up Berkshire Hathaway and sell off the parts. That's the only way they'll get full value out of this stock.
A beaten down software stock you'd buy right now?
A beaten down stock, and a stock that I like to buy right now is this Genius Sports. It's my small cap loser right now, GENI. It's trading about $5.50 a share. It's in the sports gambling and marketing business, and they made an acquisition TheStreet didn't like, but it's not a bad acquisition. The stock got hammered. It's cheap. High risk.
Okay, a beaten down software stock you would buy right now?
Oh, that's a question I get a lot of, and I don't like a lot of them. So that's a tough one. I would say ServiceNow has the best opportunity of the software stocks to recover.
All right, down more than 20% so far this year. Better bet for the next decade, AI or biotech?
It's AI 100%. I mean, biotech's always good, but AI is clearly the theme for the next decade.
Best investment advice amid all of this market volatility? Not a this or that.
HODL. Hold on for dear life. Buy great stocks and hold them forever. I'm 55 years old, last month, and I've been doing this since I was a kid. Buying technology stocks and holding them forever is the way to wealth. It's not complicated. It's not hard. It's super easy. Just buy these stocks and hold them forever no matter what they do. They'll go down 50, maybe more percent at certain times, but over time, this is the way to wealth.
All right, I have to ask, hold Bitcoin too?
Yeah, I own Bitcoin. I've owned it for a long time, and I don't think this is the time that Bitcoin's going to go up a lot, but in the halving in a couple of years, it'll go up again. And I think over time, Bitcoin is it's a good thing to own like gold.
Okay, and just finally, one sentence to sum up how you're feeling about the market in 2026.
Very concerned about valuations relative to inflation and political upheaval.
But overall, bullish in the longer term.
Overall, I'm very bullish because what we see among our clients and in business is, in general, there are lots of people making money and having savings and good jobs. There are a lot of jobs in this country if you're willing to do hard work like building homes, like just physical jobs. And there's a lot of opportunity with technology and new companies doing all kinds of interesting and fun and exciting things in all types of industries right now. So the economy is really good. It's really more like a situation that for us to screw up more than we have a bad situation that we need to improve. So in general, I think we're in a changing economy because of the different demands in the workforce, let's say for AI versus healthcare, and laying off, let's say, white collar workers with lack of experience versus huge demand for nurses, for example. So our economy is changing, but it's still a very, very good one and extremely dynamic with lots of innovation. So I'm very bullish on America overall. It's just we have a political upheaval and policies that are detrimental to the country regarding tariffs, inflation, and such.
All right, well, we'll check back in with you if we actually do get that buying opportunity. Ross Gerber, CEO,
We'll
Gerber
see.
Kawasaki, always a pleasure. Thank you so much for joining us.
Yeah, thanks for having me.